afternoon, everybody. Thank you for joining us today for our COVID Relief Bill webinar with Blue & Company. Just a couple housekeeping things. We will be recording this, so you can watch it back at a later date or share it with colleagues if they weren't able to make it. And then also, if you have questions as we go through this, if you just want to drop them in the chat feature, we will answer them as we go along or at the end. But without further ado, I will turn it over to Damien and Stephen from Blue & Company.
Thank you, Jen. Welcome, everybody. Thanks for attending the COVID Relief Bill PPP webinar that we're putting on. This one's specifically for those loans under $2 million. I do want to highlight one item of matter of housekeeping, just that the information that we're presenting is as of today, January 22nd, 2021. As you've known throughout this entire process, the clarification on the rules and the rules themselves have changed pretty frequently. So certainly take into consideration any new guidance that is provided by the SBA after today if you're viewing this at a later date. I'm Damien Strohmier. I'm a senior manager in our Cincinnati office with Blue & Company. So I focus on construction companies, primarily working with providing assurance and consulting services. I'm joined today by Stephen Mann. He's the director in charge of our Cincinnati office. He specializes in providing all types of services for our clients, various consulting, including valuation and tax services, and then also succession planning. So we're going to be talking today about the Paycheck Protection Program. I think we're gonna start by walking you through the Economic Aid Act and just starting out with some really positive news about the tax deductions. Tell you about the increased eligible expenses. So these were added categories where you could get loan funds for. Talk about the covered period, how our clients have been using that and how it's making the application process easier. The simplified application for forgiveness for those loans that are under $150,000. What the audit plan is. Just because you do have a loan under $2 million does not mean you're exempt from audit. And we'll talk a little bit more about that and what you can expect. And then we're going to talk about what we're calling the second draw. Some of the eligibility requirements for that and criteria there. So then there's also the ability for borrowers to request an increase in a loan amount if you haven't received forgiveness. And then we'll just finish up with talking a little bit about some special things for farmers and ranchers. We all know that we have, we're in that Cincinnati area and we probably know a farmer or rancher that we can help out. So with that, I think I'll jump in and just go ahead and start. I get to highlight the best news of the program. The tax treatment. So everyone that is logged in today, they know how this process has evolved over the past year, and the taxability of these deductions has been one of those key items that has went back and forth. So it's been a significant topic of discussion, and whether or not you're eligible PPP loan expenses were going to be allowed as deductions. So initially it came out that they were not going to be allowed. And that was essentially going to mean that the entire amount of your PPP loan was going to be taxable. Well, then Washington turned around and just said that, this really wasn't the intent of our program. And the Economic Aid Act, which was really issued in December, that clarified that the deductions would be allowed. So I'll say that one more time. The Economic Aid Act clarifies that the deductions for eligible PPP expenses will be allowed in arriving at your federal taxable income. And what I'd also add in here is many states, they're also following suit. So specifically, I just wanted to mention that Ohio is one of those states. Ohio is going to be excluding the amount of forgiven PPP loans from taxation. So it's going to be excluded from your gross receipts for purposes of the commercial activity tax. Overall, this has been great news for our client base that's received these loans. And it's been a point of clarification that's been great for the Economic Aid Act. So next, we're going to talk about some changes that we're calling round 2 or draw 2.
Damien, one thing on the tax slide here that I'd like to talk about is, Ohio has said that, it won't impact your CAT tax return. We've got a lot of contractors that do business in Indiana, Ohio, and Kentucky.
Mm-hmm.
And currently, right now, Indiana is going to follow the federal treatment and allow those expenses to be deductible. Both Kentucky and Ohio follow the federal rules, but only as of a certain date. So as of right now, PPP expenses would not be deductible for income tax in Kentucky and or Ohio. So there's significant legislative discussion about changing that. So definitely, if you have a PPP loan that has been forgiven, you maybe want to keep a close eye on both the Kentucky and Ohio treatment. Everything has been good news so far. We're hopeful that we get those 2 states to follow suit as well. The last thing, and I'll say that the legislature did a really good job at the federal level in also going another step to say also no basis increase shall be denied. That was something we pointed out in one of our earlier webinars about this topic, that may be an area that may come back to be troublesome as well. Well, they went and they relieved that issue. So it's going to be treated very similar to corporate-owned life insurance. If you think about that, you have a corporate-owned life insurance, you get the funds, you get an increase in basis, but you don't have to pick up the income. And the last part about that is still unknown is when do you get the basis increase? Because that basis discussion can impact, when you can take losses, when you can distribute money. And so that's a question that we still have today. We don't know if that basis increase happens when the money was spent or when the forgiveness happens. Between the two, we're guessing that it's going to be tied to the forgiveness, but we don't know that yet. So be looking for that to be an answer. The reason why that's important is they've said that the increase in basis must follow the expenses. That last thing that we have down there on the slide. So that's the reason why we probably need there to be some clarity before we file tax returns this tax season.
Okay. So additional eligible expenses sounds just like what it means. So there were some additional categories of eligible expenses that were added into the second round of PPP. Now, if you think back to the first round or draw, there was a specified amount of the loan that had to be spent on payroll, which was 60%, and then 40% could be spent on other eligible expenses. These other eligible expenses included rent, utilities, and items of that nature. So now the second draw, it maintains that 60%, 40% split, but it does add in 4 additional categories, of which we've listed 3 above, and I'll talk about the 4th. Now, the first category is covered operations expenses. Now, as you can see from the definition we provided, this includes all the expenses your business likely incurred to maintain operations in a virtual work environment. So that Zoom or Microsoft Teams subscription, add-on packages to your software that allowed for better field reporting of time or other expenses. All these would be considered covered operations expenses that you could include in your application and increase that loan amount. Our second category is covered supplier cost. Now, this really relates to restaurants. And what it's trying to do is give an opportunity for those restaurants that had orders of, perishable foods or other items that were essential to their business, but that they were unable to use. Now, I think there could be some circumstances where this is applicable for construction as it relates to materials, but being that construction was essential and, our contractors continued to operate, there likely wasn't a loss that they incurred in this category. Our third category that we're shown here is covered worker protection expenditures. So this is exactly what it sounds like. This is all the spending your business incurred to comply with requirements established by DHHS, the CDC, OSHA, or state and local governments. Now, two important things to note for this category, this covers these type of expenses from March 1st, 2020 to the date when the pandemic is declared over. And two, this goes beyond your mask and cleaning, and you should consider modifications made to your office space to create physical barriers, improve ventilation, and so on. I stress this mainly because these expenses add up pretty quickly if you really recap it over your year. The fourth category that we don't have shown is covered property damage cost. Now, this is really related to some of the social situations that were happening, and it would be property damage that resulted from those social unrest issues, and that's the terminology that they're using. But those social unrest issues during 2020 that were not covered by insurance proceeds. So something I think every construction company could consider and revisit in this category is possibly equipment or vehicles, in addition to property that may have been in the area of social unrest that your business, maybe you didn't make a claim to insurance for one reason or another, just purely for the number of claims that you may have had, or because the amounts maybe didn't aggregate to a whole lot. Well, here's an opportunity to add them into your loan amount and potentially get it forgiven down the road.
So Damien, the things that I'll add to this particular slide on these expenses is, as we've worked with clients, they've applied for forgiveness pretty much just based on payroll. So they haven't used the other categories of expenses that they could have used in applying for forgiveness because they didn't need them. And so a lot of our clients are thinking, okay, well, this really isn't meaningful for me that there's these additional expenses categories. This doesn't increase the amount of the loan they can get. The loan amount's still based upon payroll, both first draw and second draw. So why would I care about these added expenses? The reason why we're bringing it up and the reason why they should care is because another item in this Economic Act was modifying the employee retention credit. And nobody that got the PPP loan could use the employee retention credit prior to this most recent legislation, but now you can. So now we think clients should go back, should really look at all these categories and can see, hey, can I earn forgiveness, still try to earn 100% forgiveness, but without using as much payroll, still got to meet that 60% threshold, but that would then make those wages potentially eligible to earn the employee retention credit. So we're really highlighting these additional categories for several reasons, but here that one that you now need to do your PPP planning in conjunction with the employee retention credit program. And we're not getting into the details of that today, but do know that's really going to be the extra benefit from focusing on these extra categories potentially. Covered period, 8 or up to 24 weeks. When Damien and I first started helping clients when they first got their PPP loan, we were doing a lot of projections and estimates based upon the 8-week period. and we were, well in tune and helping people with all the expense categories. Well, as soon as they changed it to 24 weeks, everybody said, well, I don't even need to worry about the other stuff. 24 weeks is more than enough for just payroll alone. The payroll providers went out and developed reporting based upon that 24 weeks to show you easily earned forgiveness. And people applied and rolled on with their forgiveness applications based upon that. Well, some of the people that we were working with said, well, I don't really need 24 weeks. I almost had it done covered at 8 weeks. I really would just like to use 10 weeks worth of payroll. And their thinking was, I don't want to have to keep track of this the rest of the summer. Can I just stop? I think they knew this was a lot of work to keep track of it, especially before all the payroll companies had developed some reports that you could use. And so when they applied for forgiveness, some of them were getting the borrowers saying, no, it's either 8 or 24 weeks. Well, in this most recent legislation, they made clear, no, it is 8 or up to 24 weeks. So the beginning of your cover period starts when you get the funds, just like it always did, no confusion there, but it ends at the date of the borrower's choosing. Borrower gets to choose the end date. It just has to be between 8 and 24 weeks. So they cleared that up. Now, the other thing they did when they did that was they eliminated the alternative cover period. So if you remember what that was if you had biweekly or more frequent, like weekly payroll, then you could time up your payroll reporting for your PPP loan with your payroll periods. So essentially get alignment so you didn't have to prorate it. Well, I think SBA has learned, if we give people a full 24 weeks, timing it up doesn't matter. They don't need to do that. So they did get rid of the alternative cover period when they provided this clarity. Simplified forgiveness application. Damien, you want to talk about that?
So this was another clarification that everyone was waiting on this summer and fall. And that was for a simplified forgiveness application. This is a large part of the reason why the banks delayed accepting applications for so long, as they were waiting on clarification of various provisions that were in law. And this was potentially something that would simplify their process immensely. So specifically at the banks, they'd thrown out terminology like automatic forgiveness for loans under a certain threshold. Now, we didn't quite get to that, but we did get to a much simpler application for those businesses that received $150,000 or less in PPP funds. So I can tell you firsthand that I've walked through this with my stepdad with his simplified forgiveness application. The form is very easy to follow. And actually, was required to only be one page. So what you do on this application is you essentially certify your use of the funds and then answer some questions that provide information about the use of those funds, which is really just data gathering again for the SBA. Now, I will highlight that just because this is a simplified forgiveness application, it does not relieve the requirements of the program. And that you use the funds still appropriately. So how would that come up, you might ask? Well, you still could be selected for audit. Just because you're below the $2 million threshold does not mean that you're exempt from being under audit. Now, Stephen's going to talk more about this on the next slide. But again, just because you are below that even $150,000 threshold and we're able to use the simplified forgiveness application, it doesn't make you exempt. And because of that, you want to keep records, and we've got this on the right of the slide, but retain those payroll records for 4 years and retain your other records that support your eligibility for the program in case you were selected for audit.
Yeah, once again, we'll just say that what everybody was hoping for was automatic forgiveness. We didn't get that, but we did get a simplified process. They said, hey, the application's got to be one page. I printed it up last night. It's 5 pages, a lot of instructions and other supplementary data gathering that's optional, but the actual forgiveness application itself is one page. For $150,000 or less, you just have to say, yes, I used the funds appropriately. I maintained about this many jobs. Doesn't even appear to have to be an an exact number. And I used about this much. They use estimates or approximations, and then how much the loan is. So definitely this will be a lot less stress on a lot of borrowers. Raising the threshold up to $150,000 gets, I think, more than 50% of all the loans. So this will make it much easier on banks, borrowers, and SBA. One of the things that we have been very interested in is SBA's plan for how they're going to review or audit, depending on the term you want to use, the PPP loans. There was money set aside in the original CARES Act and additional money set aside in this most recent act to fund SBA and their personnel funds to do audits of this program for many years. So not just fund the program to process the application, but they have a oversight ability for the program and funding to do so for a 4 or 5 year period of time. And we have been anxiously awaiting how's SBA going to evaluate these. Certainly we feel comfortable with our borrowers and how they're using the funds and how they're documenting that they're using the funds. But still, we still have never been through an SBA audit for a PPP loan, and neither is anybody else. And so we're very curious about it, especially for those people that have loans over 2 million. This presentation today is under 2 million. You still could get selected. And so we really want to know how SBA is going to do that. Well, this most recent legislation, they wrote in there that SBA must give to 2 separate committees, one in the Senate, one in the House of Representatives, must provide them with a detailed audit plan. So SBA must tell them, here's how we're going to audit this program. And they have to tell them what are going to be the metrics that you're going to use in selecting these loans to be audited. We would all love to know what that is. Same thing with IRS audits. We always want to know, what percentage of partnerships or S corps are being audited, or what percentage of Schedule Cs are being audited, to try to get an idea of where IRS is looking. Same thing with SBA. We want to know where they're going to be looking and how they're going to be evaluating these loans, what they're going to be doing. And so we think we're going to get clarity on that, our first chance at it anyway, by mid-February. That's when the 45 days would be up. In addition to providing that plan to those committees, they also then have to follow back up every 30 days and tell SBA, how many active audits or reviews do you have open? How many have been open for more than 60 days? And based upon those reviews that you've been doing, have you changed your audit plan? So we believe this is the desire of Congress to be in the know, to know what SBA is doing. As we've already seen throughout the summer months, many times SBA has said, here's what we're going to do. And Congress has said, well, that's not what we intended. And then they went back, new legislations, modifications, and then there'd be new guidance. So I think more to come on this, but hopefully this will be our first look at what SBA's plans are.
So we're going to spend a little time talking now about the second draw loans and some of the additional criteria that was added for these second draw loans. First I'll start out by saying the second draw is exactly that. So one of the first requirements to be eligible for the second draw is that you must have taken a first draw loan. Now, if you are listening in and you haven't taken your first draw loan, you can still apply for this up until March 31st, 2021. Now, the next requirements that were added is a reduction in the number of employees that the business had. So they're really trying to limit the size of the business that were eligible for the loans. So if you remember the original first draw loan, that had an employee requirement of not more than 500 employees. So that is reduced to 500 for this second draw or second round.
300.
Or 300, sorry, I said 500. The next requirement is a 25% reduction in gross receipts. So this 25% reduction is in any one quarter in 2020 compared to that same quarter in 2019. Now, you can also look at your annual revenues for the full year and make that comparison, because mathematically, if you made it for the full year, you would make it for at least one of the quarters. I do want to highlight that gross receipts, that does mean revenue. So if you follow this through the act, it mentions gross receipts, and I've had clients send me a listing of their quarterly deposits to try to make this comparison. But what it's really talking about is your financial statement revenue, and that financial statement revenue on the basis of accounting that your business typically uses. So talking about financial statement revenue, not only is this the normal basis of accounting, it's also your normal processes. So this would include making your WIP adjustments and updating your estimates for known changes in the jobs. So just to be cautious as well, I would also suggest retaining documentation of your WIP meetings for these 3 quarters. I say this because contractors, we like to be conservative throughout the jobs. And sometimes there's profit gain at the end of a job that could happen or could have been otherwise recognized in a previous quarter. Some of this happens because of specific reasons. Maybe there was a contingency on the job. And those are the types of things that I'd want to be documenting around these quarterly job reviews to have those real reasons why a job included a contingency fund for risks that maybe weren't mitigated at that time, but you were able to work through and maintain your productivity. So you had profit gain on the job. Now, our last column we have up here, this really encompasses several different exclusions from being eligible for this last round or this next round. Entities that are excluded from the second draw that are publicly traded. So no publicly traded companies are eligible for this second draw. Any companies engaged in lobbying. And you're going to see several references to China here, but any companies that were organized under laws of China, have a significant operation in China, and even has a member of their board of directors who is a resident of China, or someone who files as a foreign agent. So these are all the additional clarifications for the second draw. And I think for this audience, the key factors to hone in here and to consider is your employee count. Are you below that 300 threshold? And then demonstrating that you meet the 25% gross receipts reduction. The bank is going to require that you support these items as you start that application process.
Damien, what I would add on there is if your loan is $150,000 or less, you're not required to document and demonstrate that you've had a 25% reduction in revenue with your loan application, but you must document and provide that prior to you applying for forgiveness for that loan. So, our thought there is that maybe many small companies that would have a loan that size, maybe don't do internal financial statements. And so they're going to give them an opportunity to use year-end numbers and to meet that threshold. And they may not have that together, right away. So, but if they still believe that they did experience a 25% reduction, they could apply for the loan now. The other thing is for those people that are above 150,000 and you do have to demonstrate it, and you are going to use internal financial statements, they're saying you must sign the front page of the financial statements and initial every other page of the financial statements, and essentially certifying to them being accurate. So we really don't know exactly how they're going to do that, what that's going to look like in a requirement. we're doing this presentation here on the 22nd. That became something that was made known to us late on the 19th. So we've updated this information to include that. Working with the banks that we're working with, they're still trying to figure out, okay, actually, how are we going to do that? Other than just signing it, do we need to actually put a statement on there? And we would think you would, but we'll see. So we just want to point that out. So other things about the second draw loans that are unique. One, you can use either 2019 payroll or 2020 payroll to calculate your loan amount. So what does that mean? Well, what that means is if you're getting a second draw loan, you had a first draw loan, so you've already been through the application process. We know it was based on 2019, so you could get the exact same size loan on your second draw as you got your first draw and use the exact same documentation that you provided to the bank. Some banks are asking you to send in the documentation again. Other banks are just saying, hey, if you're relying on the same thing you did before, check the box here and you don't have to provide it. So it's kind of a bank by bank basis. But if you have had increase in your payroll, or if you just get an increase in your headcount, either situation, you may want to take a look and see if 2020 might give rise to a higher loan amount if your average monthly payroll in 20 was higher. Now, it's unlikely that that's going to be the case many times because you first had to have demonstrated that you had a 25% reduction in revenue. So we would not anticipate that there would be a fact pattern where you both A, have a 25% reduction in revenue and B, increased payroll. But you could have. I have seen at least one situation where that was the case. So just be looking at that. After you calculate that average monthly amount, same as first draw loans, times 2.5, not to exceed $2 million. One of the other changes in this most recent legislation had to do with seasonal employers. And seasonal employers were mentioned in the original CARES Act. They had a special calculation that they could use. We knew that. What we didn't have is we didn't have a definition of what was a seasonal employer. And so they now have defined it to where it's more easy to understand. The first definition is what you would expect. Somebody that's business is really only open 7 months out of the year. So that sounds like your typical seasonal business. You think of something in agriculture, just runs from May through October, something like that. But then they also provided a second definition. And I don't think I could have worded it worse than they did. But what they said was that the other definition for a seasonal employer would be anybody who had in 6 months' time, your receipts revenue for that 6 months was only 33% of the other 6 months revenue. Well, I don't know about you, but it would have been much easier had they just said, and this is the inverse of this calculation, is if 75% of all your revenue is earned in 1 6-month period of time, you're a seasonal employer. So that's what 1/3 of this other 6 months turns out to be. So if I think there may be situations for some contractors that if they go back and they look at 2019 or 2020 and they look at their revenue by month, they may meet this definition. And so why would that be important? Well, why it would be important is when you're calculating your average monthly payroll times 2.5, instead of doing that, over 12 months, you get to just take any 12-week period between 2/15/19 and 2/15/20 to take times 2.5 to get your loan amount. So the reason to maybe take some time and go back and look at this is because it might give rise to a higher loan amount for your situation. So we just mentioned that. The other thing is in second draw loans is if you're in the restaurant or hotel industry, hospitality, if you will, then instead of taking your average monthly payroll times 2.5, they're allowing those companies and those industry codes to take it times 3.5. Max loan amount still can only be $2 million. Damien, you want to talk about the 150,000 and under?
Mhm. Yeah, so with the 150,000, and I'm sorry, Stephen, I'm having trouble getting my screen locked up.
So the thing we want to point out in this slide is that the simplified forgiveness application for loans of $150,000 and less applies to both first draw loans and second draw loans. So it's $150,000 each, not in total. And also, we just want to highlight something we've already mentioned, but that for those people that have loans of $150,000 and less, second draw loan, you have until the forgiveness application filing to provide the documentation that is to support your 25% reduction. And the other question is, second draw loans, are they going to be forgiven? Yes. Yeah, they're eligible for forgiveness, same as first draw loans. And yes, $150,000 under, same simplified forgiveness application. The other thing that we're adding on here is that there was some confusion about the CARES Act PPP program. Did churches and religious organizations, did they qualify? There was guidance given that said, SBA said, yeah, we believe they do. They specifically reaffirmed in the legislation that yes, that guidance was correct and that yes, they were eligible. So we've just added that.
So we did have a question, Stephen. Jordan asked, what does forgiveness application look like if your loan is over $150,000? And I'll kind of jump in here and let you add on, Stephen. What we've experienced so far is we've actually had clients go completely through the process at this point. They submitted the supporting payroll information. Typically, our payroll providers, they set up nice reports that met the exact requirements of what the application was looking for. Then the banks, they typically ask for other supporting documentation. 941s was a common request. So we submitted those, submitted the entire application to the bank. The bank turned around, and some of our clients within a week received a notice that the bank approved the forgiveness. Now, that's not the end of the process. The SBA then would have to come back and also agree that, as the borrower, you've been released from that obligation. But that has been actually happening pretty quickly too. And typically what even happens is the SBA turns around and pays off your loan prior to sending that notice that you were legally released. But the process has been very simple for a lot of our clients. No real hiccups other than just the waiting period and clarification on some of the rules to get to the point of actually submitting that forgiveness application.
There's 3 separate forgiveness applications. We've talked about the simplified one, 3508-S for simplified, and that'll be the one that all loans under 150,000 will use. Then the other 2 is 3508-EZ and then 3508. We call that long for us accountants. If you qualify for one of the exceptions, you get to file the EZ form. And what's easier about it is you don't have to do any of the reduction calculations. So you have to have a situation where you have not either reduced the number of employees that you've had between January 1 and the end of your cover period, or due to the pandemic, you were unable to operate at the same level. So those were the 2 qualifiers. If you could do that, if you can, meet one of those statements, then you don't have to fill out all of the individual employee by employee worksheets, the Schedule A and Schedule A worksheet. So it does make it a little bit easier process. But as Damien says, we've helped many clients through the long form and the EZ form. We're finding many can use the EZ form though. Next thing we want to talk about is your ability to go and increase your first draw loan. If anybody remembers what it was like back in April when you were trying to apply for the loan, the program was brand new, the terms were new, There was confusion over about how you calculated the loan. People were calling their bank and asking them for guidance. The banks were saying, we're waiting on SBA. And eventually they started accepting applications. And SBA said, if you rely on the guidance as of that date, we won't hold it against you. But it was really fast. And so because of that, it was like the wild, wild west. People having to figure things out on the fly. And there was many different interpretations, especially early on, that first, I'll say, month. They've come back in this most recent legislation and said, hey, if during you're on your first draw loan, because of the confusion, if you didn't get the full amount of the loan that you were eligible for, you can go back and request an increase in your loan amount up to the amount that you're eligible for. Or if you got the loan and all the confusion about how the loan was supposed to be used, economic uncertainty, you decided, man, I'm just going to pay part of this back or pay all of it back. And now you wish, well, I wish I had done that. They're saying you can go back and you paid all of the loan back and ask for the money back again. So essentially giving you another bite at the apple at making sure that you're able to fully benefit from the first draw of the PPP loan. SBA has 17 days to really come up with the rules on how to do that. They've put out, they've let banks know that yeah, this is going to happen, but there hasn't been a specific application that we've seen for that situation. It may be that you just have to work directly with your bank to get them to modify your promissory note, but we don't know that yet. But definitely, if that is applicable to you, that would be a way for you to get additional funds. Farmers and ranchers. I don't know about you all, but I grew up on a farm. And I know a lot of our contractors that we work with, they also grew up on a farm. So whenever there's something that's unique to farmers, I usually pass it on. And here's one. For sole proprietors, people that are Schedule C type businesses or Schedule F type businesses, and didn't have employees, the amount of the loan that they were eligible for was limited to their net profit on their 2019 Schedule C or F. Well, if any of you are farmers or know people that are farmers, you know that many farmers don't have a profit at the bottom of their Schedule F many years, mainly because the equipment they buy is really expensive and depreciation could cause them to show a loss. And so that caused them to be ineligible to participate in the Paycheck Protection Program. So in this most recent legislation, they modified the PPP program specific for farmers and ranchers, not Schedule C people, only people that file Schedule F, to say that they can calculate their loan amount not based upon net income, but based upon gross income. So whatever receipts that they had, up to $100,000. So if you're a Schedule F farmer, no employees, the maximum one you can get would be $20,833.